Have you ever wondered why it feels like everything costs more these days? Why your money doesn't seem to stretch as far as it used to? The answer lies in inflation, a hidden force that silently erodes your purchasing power. But here's the kicker. While inflation is making life harder for most of us, it's actually making the rich even richer. How is that possible? In this video, we're diving deep into how inflation is widening the gap between the rich and the poor. Let's uncover the secrets behind this financial phenomenon and explore what it means for you. Inflation, it's a word we hear a lot, but what does it really mean? And more importantly, how does it affect our lives? Inflation is the rise in the price of goods and services over time. It's the reason why something that cost you $1 a few years ago might cost you $2 or $3 today. In simple terms, inflation reduces the purchasing power of your money. Every dollar in your pocket buys less than it did before, and that's something everyone feels, rich or poor. But here's where things get interesting. While inflation impacts everyone, it doesn't do so equally. The rich and the poor experience inflation very differently. And that difference is key to understanding why the gap between the wealthy and the struggling keeps growing. Let's start by looking at what causes inflation in the first place. There are three major factors. Number 1, cost-push inflation. Cost-push inflation happens when the cost of producing goods and services increases and companies pass those higher costs on to consumers in the form of higher prices. For example, during the COVID-19 pandemic, disruptions in the supply chain made it more expensive to produce everything from cars to groceries. These higher production costs led to higher prices for consumers, a classic case of cost-push inflation. Number 2, demand pull inflation. Demand pull inflation occurs when there's more demand for goods and services than the economy can supply. When demand outstrips supply, prices naturally go up because people are willing to pay more to get what they want. The pandemic also played a role here by causing shortages in many industries, leading to a situation where too many dollars were chasing too few goods. Number 3, quantitative easing. Quantitative easing is a fancy term for when governments print more money. When more money is in circulation, the value of each dollar decreases. This can lead to inflation because there's more money available to buy the same amount of goods, driving prices up. So inflation is caused by a mix of rising production costs, increased demand, and the printing of more money. But why is this a problem? After all, don't companies just pass on those costs to consumers? And if demand is high, isn't that good for business? The reality is more complicated. High inflation puts companies in a tough spot. They have to decide whether to raise prices and risk losing customers or absorb the higher costs and take a hit to their profit margins. Neither option is ideal, and in many cases it can lead to a slowdown in economic growth. But what about the people? How does inflation impact everyday life? The answer depends on where you stand financially. For the average person, inflation is a daily struggle. Every time prices go up, it takes a bigger chunk out of your paycheck. Whether it's groceries, gas, or rent, the cost of living rises, but wages often don't keep up. This is especially true for low-income households. When you're already living paycheck to paycheck, even a small increase in prices can be devastating. It means cutting back on essentials or going into debt just to make ends meet. But what about the rich? How does inflation affect them? Here's the surprising part. Inflation can actually make the rich richer. How? It all comes down to assets. Wealthy individuals tend to own assets like stocks, real estate, and businesses. These assets tend to increase in value during periods of inflation. For example, property values often rise with inflation, as do stock prices. So while the value of cash might be decreasing, the value of these assets is going up. This means that the rich are not only protected from the worst effects of inflation, but they actually benefit from it. Their wealth grows, while the purchasing power of the average person's income shrinks. This is why inflation is often referred to as a wealth transfer mechanism. It transfers wealth from those who hold cash and have limited assets, often the middle and lower classes, to those who hold inflation-resistant assets, the wealthy. Let's take a closer look at some of the specific ways in which the rich can actually profit from inflation. Number 1. Real estate. Property is one of the best hedges against inflation. As inflation rises, so do property values and rental income. If you own property, you can raise the rent to keep up with inflation, ensuring that your income remains steady or even increases. But if you're renting, you're likely to see your rent go up, eating into more of your income. Number 2. Stocks and bonds. Companies that can pass on higher costs to consumers often see their stock prices rise during inflationary periods. Additionally, bonds that adjust with inflation, like Treasury inflation-protected securities, can offer a steady return that keeps pace with inflation. Wealthy investors often have diversified portfolios that include these types of assets, allowing them to not just protect, but grow their wealth. Number 3. Businesses. If you own a business, you have more control over pricing. You can adjust your prices to keep up with inflation, and if you have the right kind of business, you might even see increased profits. For example, businesses in essential industries, like utilities or consumer staples, can often pass on higher costs to consumers without losing customers. So, while inflation is squeezing the wallets of the average person, it's padding the pockets of those who own assets. This creates a vicious cycle. The rich get richer, and the poor get poorer. But what can you do about it? Is there any way to protect yourself from the negative effects of inflation, even if you don't have millions of dollars to invest? Here are a few strategies. Number 1. Invest in assets. You don't need to be wealthy to start investing. Even small investments in stocks, bonds, or real estate can help protect you from inflation. The key is to start small and be consistent. Over time, these investments can grow, providing you with a buffer against rising prices. Number 2. Diversify your income. Relying on a single source of income can be risky, especially during periods of high inflation. Consider finding additional income streams, whether it's a side business, freelance work, or passive income sources like investments. Diversifying your income can help you stay afloat even as costs rise. Number 3. Reduce debt. High inflation often leads to higher interest rates, making debt more expensive. Paying down debt as quickly as possible can free up more of your income to deal with rising costs. Number 4. Live within your means. This might sound obvious, but it's important to resist the temptation to overspend, especially during inflationary periods. Living within your means and saving where you can will give you more flexibility to handle unexpected expenses. Number 5. Stay informed. Knowledge is power. The more you understand about inflation and how it affects your finances, the better prepared you'll be to make smart financial decisions. Follow financial news, learn about economic trends, and keep an eye on how inflation is impacting your own budget. While inflation is a challenge, it's not insurmountable. By taking proactive steps and staying informed, you can protect yourself from its worst effects and even find opportunities to improve your financial situation. Inflation is a complex and often misunderstood force in our economy. While it can make life more difficult for the average person, it also presents opportunities for those who are prepared. The key is to understand how inflation works, recognize its effects on your finances, and take steps to protect yourself. If you found this video helpful, then don't forget to like this video and subscribe to the channel for more insights into personal finance. Thanks for watching, and we will see you in the next video.